Good afternoon, everyone. Thank you very much for joining me on your Wednesday afternoon. I hope everyone's got their lunch in front of them or something. Just really want to thank everyone for joining me. I love this stuff, but understand it's pretty boring for a lot of people, talking about markets and procedures. So yeah, thanks very much for joining us. My name's Oliver Straker. I sit on the BDO Investment Committee here, and I'm a wealth advisor in the private wealth team. We are responsible for managing the investments for large family groups and charities such as yourselves, and talking with some of the not-for-profit partners here. There's been some recurring themes that we've seen across a lot of our large not-for-profit clients. So thought it might be a good opportunity to first of all give a bit of a macro update on what we're seeing in domestic and international markets, and then talk through the way we set up investment portfolios. We really believe in the way we set these up. So yeah, I'll first of all just start with the investment update. If you'd like to ask a question, just hit that question mark box there, and there's a support button on the bottom too. You'll be sent these presentation slides around at the end. The session will be recorded, and my details will be at the end as well. If you see any products in here and research, this is all general. Obviously, we haven't taken into consideration all of your individual circumstances, so it's all general advice. So over the past couple of years, we have reviewed a lot of family office and not-for-profit strategies. One of the largest reasons why we've seen it is clients have seen portfolios move in very significant ways, particularly in 2022. We've seen a pretty nice recovery in 2023, particularly in those defensive asset classes, things like government bonds. And you know, when we review these portfolios, of course, we can look at the individual investments and tell people why they've done certain things, but we believe in setting up the framework at the start is the most important part of setting up a strong investment strategy. If you have the right framework in place, you'll understand why assets move in certain ways, and obviously it's not nice seeing investments move in very volatile ways. But if you set the strategy up to put certain capital into certain investments for either a short, medium, and long-term time frame, this can give you and your investment committees confidence to ride through the markets. So, as I said, in 2022, assets moved in really significant ways. Warren Buffett said that interest rates are to asset prices like gravity is to the apple. What he's saying there is the higher interest rates go, valuations just get smashed, and in particular, long duration assets. So these are things like 10-year government bonds, 30-year government bonds, and things like tech as well, because you're paying for those longer earning cycles. So you can see for periods ending in 31 December here, we've got the Australian share market at the top, and I've underlined the 1-year return, -1%. The Australian government bonds did -12%. The US share market, which again is very tech heavy, did -12%, and inflation was 7.8%. So in 2022, not only were you losing out quite heavily if you invested a lot in long duration government bonds, coupled with inflation, you had a really nasty year. And we had a lot of questions from clients around these defensive assets, because it is a very common investment for not-for-profits, things like government bonds, long duration term deposits, things like that. So that was last year. Thankfully, we've had a fair bit of recovery this year in broader markets, which we'll go into a little bit more detail soon. So over the next probably 20 minutes, half an hour, I'll give a global and domestic market update, and then at the end we'll run through the investment process. But please ask any questions that you have along the way. So in a nutshell, 2023, sorry, just a second here. In 2023, the market at the end of 2022, valuations had been slammed by the prospect of rates going up. and everyone thought that earnings were going to suffer as a result. What they didn't realise is the savings that US and Australian consumers had actually held up quite well. So you can see the savings rate was quite strong. Now it's starting to drop quite heavily, but that meant that earnings revisions remained quite healthy this year, and that's why markets have actually rallied quite a lot. So we'll now dive into the Australian market. So returns to 30 June across the share market have been quite strong, 14.78%. The Australian market is dominated by bank and material companies, things like BHP, Rio Tinto, CBA. These guys make up over 30% of the Australian ASX 200. So they are actually quite, they react positively to higher interest rates. Banks earn more on the spread between your mortgage and your savings rate. Speaking from personal experience, I hate it when my mortgage goes up, but then the savings rate doesn't go up as much. In a nutshell, that's how banks make money. So higher interest rates, banks have been earning more money, and we've seen that in recent profit figures. Similarly, materials tend to go up when interest rates go up as well. They're kind of at the start of that inflation cycle. Inflation goes up, usually the demand for coal and iron, for steel, goes up as well. That's really the start of your inflation cycle, is the materials, and then flows through. So the Australian market for the past year has done quite well. Common question we get from clients at the moment is, my portfolio has done X, I can get term deposits that pay me 5%. Why aren't we just using term deposits? Well, yes, that's all good and well at the moment, but remember what term deposits were last year, and if we've locked in a term deposit at, say, 1 or 2% for 12 months, you wouldn't be very happy with your advisor if that was the case. So it's important to remember that equity markets are a rolling return, whereas term deposits, you're really locking in those returns. Australian government bonds have recovered somewhat as that yield has come up, but it's still a shocking 3-year return, just because the sheer velocity of those rates coming up has really hurt the capital value of those bonds. So the top one is the government bonds. The bottom one is the composite, which includes corporate bonds, things like bank bonds, Port of Brisbane, things like that. The capital value of these bonds has come down quite a lot as rates have gone up. The flip side of that is, as if you imagine a bond that you buy in, say, $100 lots, the market is constantly trying to reprice that bond to get a relevant yield for the risk that you're taking on. So the Australian composite bond index is, as those rates have come up, the price of those bonds have come down, and you can now invest in quite high quality bonds with arguably low default risks, and it's yielding 4.39% as at today if you just held all those bonds to maturity. If rates start going down, you might get the flip side effect where you actually might get capital gains in that index. So although it's been a terrible place to be for the past few years, you are now compensated somewhat for holding those bonds. So there's a few graphs going on in the Australian in this Australian market graph. I just want to, it tells a story from the left to the right. You can see, as we're talking about, the savings rate has come down quite a lot this year, and so basically what that is that it's the percent of the household disposable income that's going towards savings. Obviously, a lot of Australian families have mortgages. As the rates go up, your savings rate goes down. And you can see in this next graph, the household debt and debt service ratio. The service ratio has just come up very significantly, up to around 7%. And you can see our household disposable income, the assets we have, has come up quite a lot as well. So that is somewhat alarming. You can see the consumer sentiment and business confidence has come down as a result of that, and the retail sales are coming down there as well, obviously, as people are putting more money towards those mortgages. So that's really the story of less savings because of higher mortgage rates, which is affecting retail and business confidence, which is exactly what the RBA wants. This is what's going to get inflation down. Is hopefully it starts affecting the core inflation, and as you'll see, this has affected business investment as well. So as interest rates come up, and the risk-free rate comes up, those government bonds that I was talking about, it makes it harder for businesses to return to making a good returning investment in themselves or externally, because they can buy government bonds at 4%. So the hurdle rate for a CFO to present something to the CEO to reinvest in it in their company has come up quite a lot, and as a result, we've seen a reduction in investment domestically. The mining sector has dropped off very significantly over the past 6 months or so. This is because through a recession, there's lower demand for materials. So mining companies are really tightening their belts at the moment. And as you can see, construction has also come down as well. I thought some of you might find this interesting. I know a lot of the charities that we look after are focused on the issue of housing. You can see in the graph to the right, these are the components of inflation. So when you hear those figures of, say, 7% inflation, this graph actually breaks down what was making up those inflation figures. So inflation, or the consumer price index, is just a basket of goods, and the ABS measures the difference of the price from this year to last year. So it can be down to something like toothpaste. How much has the price of that toothpaste gone up from one year to the next? That makes up a tiny component of this inflation figure, but the big ones have been highlighted there. So the big ones there that we look at are housing ex rents in the dark blue, and food, for example, as well, energy and fuel, and housing ex rents as well. So you can see that housing is still really affecting those inflation rates, which is what the RBA is focused on. Now, it's a hard game the RBA is trying to play, because they want housing to come down, and rents in particular, but they don't want to cause a property collapse, because Australians are quite leveraged into the property market. So it is a hard game they're trying to play, and that's when you hear that hard versus soft landing. Can they get inflation down to their target rate without putting the economy into recession? Historically, it's been quite hard, but we'll see. So these are the components they're trying to get down. Again, so your housing finance and house prices vary in line with each other. Housing prices over the past couple of months have actually ticked up a little bit. That may have been, could be a whole host of reasons, but one of the major reasons is mortgage costs may be flattening out. So when the RBA hikes these prices, banks are always setting mortgage rates, particularly the fixed mortgage rates, based on where they're expecting rates to get to. So if the RBA is coming out and saying, oh, we think there might be 1 or 2 more, the banks are trying to predict that fixed rate. So if those fixed rates are starting to flatten out rather than just going up and up and up, then people get more confidence around what their repayments are going to be over the few years, and that extra confidence may result in more people purchasing houses, which may be a reason for why the uptick in houses has happened. The RBA is probably not happy about this, because they want housing to keep coming down without causing a collapse. You know, when those loan to value ratios get out of whack, they don't want to see that. So the global markets, the MSCI World Total Return Index, this is the most commonly used index, and I'll speak about it in the next slide. This is a combination of around 1,500 companies that are publicly traded around the world. You can see over 5 years it's done quite well. 1 year it's done incredibly well. This is hedged back into Australian dollars. Again, the Global Treasury Index, so these are all your global bonds. There'll be a lot of US government bonds in this index, has had a terrible time as interest rates have come up. Because the thing about bonds is you buy a fixed term of coupons. So when you buy a government bond, you might buy it for, say, $100, and the government says, we'll pay you 4% interest over the next 10 years, and then you get your $100 back. So it has no opportunity for earnings growth like a company does. If you buy an Apple today at, say, 25 times multiple, yes, you're buying an expensive company on a multiple basis now, but if the profit goes up by 40% next year, that means the multiple you bought it on is actually quite a lot cheaper, but bonds can't do that. So that's why they're very interest rate sensitive. Again, on that global treasury index, you're getting about a 3.8% yield. That index has quite a lot of Japanese bonds in it too, which are having terrible yields at the moment, still quite low. So I'm going to speak about the US a lot as part of the global market update. And the reason why that is it just makes up so much of the publicly traded market. I don't think people realize how massive some of these US companies are. You've got a handful of companies that trade over $1 trillion market cap now. Companies like Apple, Amazon, Alphabet, these companies are massive, and they make up a very big chunk of overall earnings around the world. So the US is a massive cog in the global economy. If it slows down, the rest of the world will probably slow down as well. There'll be little pockets, but the US market really matters in terms of the global markets. You can see there as well that information, if we had this graph, if we had this chart on the right, which splits up the different industries, maybe 15 years ago, it'd be much heavier financials based. So these information technology companies, like your FANG stocks, they call, like the Netflix, Apple, Amazon, Google or Alphabet, they really make a big chunk of the market. So inflation is coming down around the world, which is pleasing to see. It is coming down faster in some parts of the world. The US has, I've said here, has taken its medicine a bit faster than everyone else. Most economists agree that the central banks are a bit slow to get on the front foot by raising rates, but the US, once it realized inflation was a problem, has been on an absolute tear, and they have really been hiking rates. So our cash rate at the moment is about 4.1. Theirs is around 5.1. They're similar rate. So they are higher than us. They have a very different system to us, where you can fix a mortgage for 30 years. So our rates affect our economy differently, but they have increased faster than we have, and they are seeing quicker results. They are still struggling though with the things that I spoke about, housing. They're struggling to bring down. One of the big factors that has come down in inflation is energy, which can be quite weather-based. So when you go through winter, that may spike again, but their inflation is coming down a fair bit faster. Europe's is not coming down as fast as the European Central Bank would like. Particularly the UK is really struggling to get down their inflation. So you can see that forecast there on the left. The Eurozone, I mean, is predicting a really sharp downwards turn. Whether that happens or not, we'll see, but so far the trend seems to be quite positive, which has been a factor of why markets have rallied quite a lot. As I said, interest rates act like gravity on the way up. It really brings valuations down. It can have the opposite effect the other way if rates come down very quickly. And when I talk about rates, these are expected rates in about a year. If these rates keep going down, people will pay more for the earnings of a company. So you will see markets could rally if earnings hold up in equity and bond markets. So one of the big leading factors into inflation is wages growth. Wages growth has been quite sticky, which has been a concern for markets. That's why they kept hiking, because it can lead to this nasty double-edged sword where wages growth leads into inflation, which feeds into wages growth, and it can just start this nasty double-edged sword. That has been coming down recently, which is pleasing to see, but it has been sticky up till about a couple of months ago. So it sounds horrible to say, but wages growth going down can be positive for inflation. Real wage growth has still been really slack though, so people's wages going up above the rate of inflation is still very low. So that is disappointing to see. Trade activity has been slowing. So this is your manufacturing exports across the world has been slowing. This is probably in prediction of US recession. So exports have been slowing down as well. Supply chains have healed quite a lot. So you might remember when the war in Eastern Europe kicked off, lots of food concerns, gas concerns with gas flowing into Europe. These markets seem to be healed somewhat, but the European winter will be interesting to see what happens with the amount of reserves there. But the supply chains have seemed to have fixed themselves, but export growth is still slowing. Just got some valuations here across the world. So the US is trading above the 20-year average. This all needs to be taken into consideration with interest rates, though. It's not really worth measuring it in those large averages. You can see there that the world is trading above the average, and just on the graph on the left, you can see dividends are starting to make up a good chunk of that total return now. So the one on the left shows you the total return of an investment. Say if we take the US in the last year, the earnings per share growth has made up a small portion, dividends have made up a small portion, and then that multiple growth. So say you were buying Amazon for 15 times earnings, or say, that's probably a bad example. Say you're buying Apple for 20 times earnings last year because people were predicting rates to go up quite significantly. Well, they probably didn't go up as high as people thought, so now people are willing to pay 25 times multiple for it. So that has been a really big source of the returns. And then your currency there, the Australian dollar has strengthened a little bit, which has brought some of your return back there as well. Income has been quite pleasing in Australia over the past year, which is probably quite important for a lot of your investment portfolios. Australia has been the right place to be compared to the rest of the world. You can see the US yields about 1.5%, whereas we're up at probably 4.25%. If you couple in the franking credits that you would also be getting in your portfolios, because you have 0% taxpayers, this can lead to quite a nice yield. So we are focused quite heavily on the yield in our portfolios, and whilst it's not pleasant to see the capital move up and down, seeing that constant yield come in it can be reassuring. So what does all of this mean across Australia and the US? I often say that economists are about as good as a weatherman. You can't trust them very much. They often get it wrong. That being said, most economists believe a recession could be on the way in early next calendar year. No one knows how deep it'll be. No one knows if it'll even happen. But at the moment, it seems to be a consensus that it could be quite shallow. If that's the case, you may see markets go quite well next year. If it's a deep recession, if there's some nasty credit out there that goes bad, and we start seeing some defaults, then it'll go the other way. And isn't this great? The last Bloomberg survey said that there was a 50% chance of a recession. So you can't really do much with that information. We will note that we don't trade based on macro information. Warren Buffett's very famous for that. You know, he doesn't make any investment decisions based on macro decisions. It's sometimes it's nice to know why markets are performing the way they are, because the economy and the markets are sometimes related, albeit with either a lag or a forward prediction. But that's just what the economists are predicting in the next year. So with not-for-profits, I've mentioned franking credits. These can be a really good way to squeeze out some extra yield for not-for-profit portfolios. So it's worth talking to your advisor about what they are doing to harvest those franking credits if they're not, and if it matches your objective. So you can see here the graph on the right is the return in the Australian market, that dark figure, and then the franking credit is the added that you get back. So that's, you know, the tax that the for-profit companies have already paid. What does that look like over the long term? You can see over 3 years that could be 1.5% difference to your total return. So that tax exempt is the line on the bottom. So it can be a really good way of just getting a bit of extra yield out. Now, obviously, investing in the equity markets brings with it risk. So just make sure if you're talking to your advisor, it matches with your long-term risk appetite, and, you know, matches with your organisation's mission objective as well. But definitely well worth having a look at franking credits if you've got a long-term outlook. Another place that has worked quite well over the past few years is diversification and just good quality companies. So here I've put the index, which is in that maroon, dark red line, and then in the blue line is the global index, that global MSCI index that we spoke about before, that's been screened for quality factors. So those factors, high return on equity, stable year-on-year earnings growth, and low leverage. Now, remember, the global MSCI is quite naturally well diversified. Screening out for quality companies has seemed to work over the past few years. Obviously, it's no guaranteed for future performance, but if it matches your organisation's portfolio risk appetite, having a good mix of quality companies in there has worked over the past few years. So that was on the growth side of so just say you've got a portfolio that's 60% growth, 40% defensive. Having those quality companies in the growth side has worked, and a diverse mix of investments as well. On the defensive side, we spoke about those government bonds, how they've been really hammered by higher rates over the past few years. What's worked with the defensive side is having a mix of floating rate credit. So that is credit that goes up with interest rates, and now you might be considering diversifying into some of that more longer duration assets as well. So your floating rate credit, the way it works is, say a bank wants to raise some money to then lend to variable mortgages. They can come to investors like us, and we can buy some of that floating credit on behalf of clients. Then when interest rates go up, you always maintain a spread above the cash rate, and that's where your yield comes from. Now, that works well when interest rates are going up, but when interest rates start going down, so does your yield. If you can lock in some of those term deposits, which, you know, so you're seeing some pretty high quality credit out there, between 5 and 6% at the moment, across a 5-year duration. When interest rates start going down, you can get that capital gain on the bond as well. So just making sure, if you do have a portfolio, that the portfolio is well diverse across high quality debt. You certainly don't want any defaults if we go through a recession, but also if it's diverse in terms of floating rate and fixed rate bonds as well. So we've spoken a lot about markets. Now, the markets will go up and down over any cycle, but we find that setting up the right strategy for different portions of your portfolio according to what your organization's mission objective is and your capital requirements can yield the best results. Because if you have capital that's not going to be touched for a long time, for example, you could take a different risk approach to capital that's not going to be needed for 3 years. So this is the way we set up investment frameworks here at BDO. It starts with your objective, and this is usually a really interesting exercise we go through with the board, because a really common trigger is, hey, we got this cash, we want to invest it, and we are not market timers. We're not traders. We're not going in and out of companies on a daily basis. So we ask the not-for-profit, well, what is your objective for these funds? Is it going to be used for housing in 10 years? Is it a school a bursary foundation? Is it a medical association? When's this capital going to be needed, and how does it tie into your objective? And then we can start the conversation. So that's honestly quite a rewarding experience for the board and us, because it can sometimes be easy to get wrapped up in the day-to-day exercises, as I know a lot of not-for-profits, because you're running low staff, you're really focused on the day-to-day, but sometimes it is nice to take a step back and go, well, what are we trying to do over the long term? Because that's what we're trying to achieve with these portfolios. The next stage after setting up the objective is your governance, and we'll go into a little bit more details about this. This mainly revolves around your investment policy statement, which sets the risk parameters of the portfolio. It also sets up the delegation of authority across the board. So what's the chair doing? What's the finance audit and risk committee doing? What's the CFO doing? It really delegates that responsibility. Then we get to the next stage, which is the strategy execution. So once the investment policy has been done, we understand what assets we're going to be investing across, what asset classes we're going to be investing across. Now it's time to come up with the portfolio that matches that risk appetite. So we do a fiduciary analysis, we backtest portfolios, and then we create the strategy. Next step is actually physically investing the funds. So setting up the portfolio, getting the money across, investing the money. The next step is the ongoing review. So is the portfolio doing what it's supposed to be doing? We benchmark performance every year. We make sure the investment policy statement still holds up and is still aligned to your goals. So when we set up the strategy and your capital requirements were X for 7 years, we meet with you next year and say, is that still your objective? Because if it isn't, we may need to change the portfolio. So that then goes back to the objective, which then we review governance, and it's really this cyclical process each year. So the objective, as we spoke about, we determine where the funds are going to be used. Does the strategy line up with the organisational mission? We model out different scenarios just to see what free cash flow might be like. So sometimes we can look at what's your worst loss been in the past 5 years. Let's use that as a worst case scenario, times that by 3. Possibly there's a buffer. We look at your capital requirements for a short, medium, and long term, because that's going to be really important determining in what assets we can invest in. There's no way we'd be looking at high growth international equities if the money was going to be needed in 3 years. That just doesn't make any sense, because the last thing we want is you guys tell us to start this investment strategy for you. You say you need this money in 3 years for a housing project or some large capital requirement. In 3 years' time, some global financial crisis has happened. That's a really unpleasant conversation to have from us to you, but for you to your stakeholders as well. So it's really important to understand what your capital requirements are over that time frame. So once we understand what your objective is, what your capital requirements are, we can look at the type of strategies that might work for each one of those strategies. So this is just an example. Remember, this isn't advice at all. But your short-term capital, this is your 1 to 3 year capital. You should just be trying to get cash, maybe a little bit higher than cash. So obviously you should be limited to at least cash. Maybe some fixed interest investments like term deposits, some really short-term investment grade bonds possibly. Your medium-term capital, again, cash, fixed interest investments, and maybe a small allocation to international and to domestic equities and infrastructure. Your longer-term capital, that's where we can start to take on a little bit of risk, and that's when we really start to focus on trying to outpace inflation to get the best results for your members. You've got to remember, it's easy to say it was good to be in cash over the past, in 2022, for example, because you weren't getting a drawdown of capital like you were in government bonds and equities. But over the long term, if your cash isn't keeping up, if your funds aren't keeping up with inflation, you may also be doing your stakeholders a disservice. So it's really important to try and marry up those strategies with those timeframes, because that's how you'll get the best results for your members. So the next step, if you just remember, I'll just go back. The next step is governance. So that's second tile. This is where we often start with a bit of education to the board. So like you've just heard with a market update, we can provide a little bit of a market update of domestic and global markets, explain to them what different asset classes are and how each asset class might fit into the strategy. Look, some boards like this education process. Some already have experience on the board. We often find boards usually have members of the organisation or users. They've got good accounting experience. They might have good legal experience. Sometimes they have investment experience on there as well, and that's where we might say, well, look, you have that experience there. Maybe the education isn't required, but more often than not, that investment experience isn't always there. So we like to work as a consultative approach, which might mean attending AGMs, attending board meetings to explain what investments are in there and what kind of risks you are taking on behalf of your stakeholders. This, the investment policy statement is really setting the parameters around what each one of those buckets is doing, what we're investing in according to each one of those buckets, and it informs either us or the investment manager how they can invest the money on behalf of your members. So it's showing your stakeholders that you have undertaken planning. You haven't just thrown this money into a portfolio. You've really planned and allocated capital across investments according to what you're trying to achieve. This will also delegate the responsibility to the investment manager. It'll also delegate the authority across the organisation. So who is actually approving the investments? Is it the Finance Audit and Risk Committee? Are they meeting with the investment advisor quarterly, 6 monthly? What kind of reports are they getting? How much is fed up to the board? Those are the kind of things that we flesh out in the investment policy statement. And it'll also outline if you have any environmental, social, or governance beliefs. So this is a very common theme for not-for-profits. They don't want any exposure to armaments, slavery, things like that. And so your advisor should be able to filter out those investments, or at least tilt the portfolio towards those investments. There has to be some care undertaken in the investment policy statement to say that they're not absolutely filtered out, because we have come across portfolios before where the investment policy statement says it filters out these things, but if you're buying a broad-based index, there's no way of knowing at any one point in time you're not invested in some of those assets. So you've got to be very careful with the wording in your policy to say that to the best of our ability we are trying to do X, Y, and Z. So this might be an example of the asset allocation that you might have in the portfolio. So again, not advice, but it might be, this is the type of thing that you'll see in a portfolio. So you have a bit of cash, a bit of fixed interest, some shares, possibly a heavier weighting to Australian shares to get those franking credits, international property and infrastructure. And this asset allocation may change depending on your bucket. So this one, for example, might be like a 6-year plus strategy. So we've done objective, now we're going into the strategy execution. So this might be, sometimes people use the one provider to do all of this. Sometimes for much larger portfolios, you may split this between, so up until now, you might use a consultant to help you come up with the investment policy statement, split up the, authorities, and then you might go use that consultant to tender out the actual investment process to someone else, or you may keep it with the one provider. That's usually a decision that the board makes. So once the policy is in place, this is where the analysis begins to actually list out the investments that we want to use in the portfolio. So this will involve back testing the portfolio, see how it performs through a GFC, a COVID level event, how big's the drawdown, does the yield hold up to what you guys need, and then it goes to the board for authorization. So this is again not advice, and I haven't actually listed any funds out here, but this might be the type of thing that you'll see from a provider. You might have a bond credit fund, you might have direct bonds in there, you might have a property fund with some indexes. In maybe some rare circumstances, you might have some private funds in there, and so they'll probably list out the funds, the performance, the type of holdings that are in there. That would be in the strategy execution tile. So the portfolio is invested, so they invest on behalf of the charity, and then once this has happened, that's when the ongoing relationship begins between you and whoever has invested the money. So this changes depending on the not-for-profits. Some organisations like monthly meetings, some prefer quarterly, 6 monthly. It's up to them, but the advisor should be able to tailor that service to you. Possibly deal direct with your bookkeeper, get a data feed of the portfolio to your bookkeeper if you're using one. And so you should be able to track or get a login to see the portfolio on a daily basis. Yeah, so we've spoken about that, your quarterly, monthly meetings with the FARC or the CFO, depending on who's there. It's important to mention that whoever you use as a consultant or a manager to run the funds, they can act as, they can sit in on your board meetings, and I do this with some clients to explain the investments and go through the performance. This can be reassuring, particularly before an AGM or something, if you have questions from the stakeholders on why the portfolio has done certain things. The performance needs to be measured against a benchmark too. The benchmark should be chosen as part of the investment policy statement, so you're not backwards testing it according to what the manager wants to benchmark it to. So you want to set that benchmark from the start and make sure that the performance is holding up according to that. So we've spoken about the segregation of duty. So those first two steps, and it depends on how large the portfolio is. This is not a hard rule, but we typically say if it's over 8 or 10 million, usually a portfolio can handle the cost of a consultant and an advisor or manager. Underneath that amount, it can start to detract from returns. But sometimes getting an independent review of a process can help you, first of all, review costs, because unfortunately our industry is quite opaque and fees aren't always obvious. We can actually look at the fees you're being charged on a fund basis, on an ongoing review basis, but it also helps you review the portfolio to make sure that you've got funds in there that actually match your investment policy statement. So sometimes splitting the roles between that governance level, so doing your investment policy statement, making sure it lines up with your objectives, and then below the line, so that investment advisor or manager, those people who are actually running the money, it can actually give you some clarity over if that manager is doing the right thing according to your policy and your stakeholders. So as a conclusion, the global and domestic markets are uncertain. There is, these economists are predicting recession in the US next year. Whether that happens and how it affects markets is quite uncertain, but setting up the right strategy, setting up the right framework according to your risk appetite, when the capital is needed, will be the most important thing. This will give you confidence throughout the cycle. So if you see your portfolio go down, and it's not nice to see, we all appreciate that, but you know the capital's not needed for 7 years, and that's what you've all agreed on. If it's matching up to the benchmark, you still have that risk capacity of that run up. So I feel sorry for the portfolios that sold out last year, and we certainly didn't advise on that last year. Through that cycle, when they started to see negative returns, who have now missed out on returns this year, this is the kind of emotional game that can be at play if you don't have a proper framework set up. And that's why we really believe that the actual physical investment of the funds should be one of the last steps in building that strong process, because it will give you confidence, your stakeholders confidence to write out those cycles. So that's all from me. Did anyone have any questions? Looks like no. No. I'll just give it 30 seconds or so, and then we'll let you get your last 15 minutes of your lunch break back, hopefully. No, it doesn't look like any questions. Look, thanks again, everyone, for joining in. Really appreciate you taking your time on your Wednesday afternoon. If you do have any questions, you'd like us to take a look at your process, your framework, your portfolios, we would be more than happy to have a chat to you. So please don't hesitate. Oh, we got two questions. That's okay. Yeah, you can send them through, Katie. Covered call strategies common given franking. Yeah, look, the covered call strategies, they can be quite complicated. You can often get capital gains in them, and often sorry, there's other questions coming. I'm just going to keep answering this covered call strategies. So the covered call strategies can work, but they can also result in lumpy capital gains if the call is wrong, because you end up getting the return via capital rather than income. So we haven't looked at them too intensely. We prefer buy and hold strategies for Australian shares. They're usually cheaper. You will get the franking credits. And yeah, we find them to be better ways. But to be honest, I haven't had too much exposure to those strategies, but you will get more capital gains in those. This is very interesting. Is there any guidance on what dollar value / percent of cash or non-cash warrants setting up in the framework you are outlining, or is that a matter of the board's risk appetite? So great question. There isn't a hard and fast rule on how much cash you could have. It's really dependent on the organization's objective. So if we look at this, so this bucket strategy is a way of somewhat quantifying it, but there are qualitative aspects to it as well. So this 1 to 3 years cash requirement, for example, that might be a minimum that you'd like to have as cash, but then some boards like having a buffer of an extra, say, 2 years of worst loss outcome, so that if you have some really nasty capital requirement gets sprung up, you don't have to sell assets that might be locked up in the higher risk appetite part of the portfolio. So good question. There is no hard rule on it, but there is a quantitative way of looking at it, but then it's the qualitative view of what the board's risk appetite is, and yeah, how much they actually want to set aside in cash. I hope that's answered those 2 questions. Okay, great. Thanks very much for those questions, and thanks for hanging in there, everyone else. As I said, my details will get sent to you. Please reach out if you've got any questions. This is the work we do with our not-for-profit clients is by far some of our most rewarding. So yeah, we'd love to work with you if you want to reach out. Thanks, everyone.